Hi, I'm Jackie Ware,
Hi, I'm Madeline Bearn, and you're watching.
episode 12 of On Air with Jackie Ware. Hello and welcome back to On Air with Jackie Ware. I'm joined with Madeline Bearn, Director of Marketing Analytics at CoStar. This is our mid-year check-in where we're diving into trends, shifts, and signals shaping multifamily as we head into the back half of 2025. This is a very special episode as we celebrate our first year of podcast, and this is also Madeline's first podcast ever. So let's dive in. So, can you start by sharing a bit more about your role as Director of Market Analytics at CoStar and how you got into this field?
Sure. So I've been with CoStar now for about 2 years as the Director of Market Analytics. I sit in Atlanta, so I cover multifamily as well as office, industrial, and retail.
Wow.
So I'm really ingrained in the Atlanta market. If some listeners are CoStar users, I write all of the reports about Atlanta. I give state of the market presentations. I talk with different industry groups, and I really like to talk with market participants to see, is our data really telling the story of the market?
Okay, wonderful. So, what initially sparked your interest in market research and analytics? Has that always been a passion of yours, or how did that come to be?
Yeah, I think I've always come at it from the perspective of loving cities and regions and really trying to figure out how they work. So I wanted to go back to grad school. I went back for city and regional planning after I finished up college, and I really focused in on economic development because I've always been interested in finding out how can we have better employment, how can we improve the workforce. So that's where I focused in on in grad school. I went from there to some consulting work in economic development. And then I was eventually director of research at Metro Atlanta Chamber. So coming to commercial real estate from the background of helping companies who are coming to Atlanta with the site selection aspect, figuring out the demographics, what the story of our region is, with that kind of demographic economic background, I found my way to CoStar, where I've been really digging into the different set of data that's behind commercial real estate.
That's amazing. So, I think with all that background knowledge, that really helps you report on multifamily trends, correct?
Yes.
Would you say multifamily is your favorite?
I actually would. I love multifamily because I think it most directly correlates with those demographic trends that I
Mm-hmm.
like to study. And just, it's pretty much one to one of what people are thinking and what people want to do. I also just enjoy, I think, when I go out and talk to industry groups, I think multifamily operators are probably the nicest, most fun groups that I talk to. So I always really enjoy that.
I would say that as well. We're pretty fun and out there. We have
Yeah.
to be to keep our sanity, right, with all the residents
Yes.
and the shifts in the market that we can't control.
Yes.
So, what are the key trends shaping the multifamily market in Atlanta specifically?
So I'd say three big things are part of the narrative right now. So one, we are coming off of a record run of adding inventory to the market. Since 2019, the Atlanta multifamily market has grown by about 20% in terms of units, which is just a massive amount of growth. We now have more occupied units than we even had total units just 5 years ago. So that massive amount of supply. Right now, the second part of this would be really strong demand. So in 2022, when inflation hit the country, it hit Atlanta especially hard. So we saw a real contraction in household formation. But then over the past year and a half, we've seen move ins really increase and build. We're about near peak absorption. So that's move ins minus move outs, which I think is really great for a market with a lot of supply. And then the third factor, combining those two, where we've had this big mismatch of supply and demand for a couple years, We've had negative year over year rent growth for the past 9 quarters. We think that's changing this quarter. So
You are making a lot of people happy. Oh my goodness.
we really feel like number three part of the narrative, rent growth is coming. So I feel like I've been talking to people in the multifamily for the last 2 years and really having to tell this kind of rough story of we're in this trough. Things are a little difficult for sure, but now we feel like we've reached that inflection point. We had demand surpass supply last quarter, and so we think we'll get rent growth back this quarter.
I know you don't have a crystal ball, but when are you thinking about that just for our listeners?
Yeah,
Because
definitely.
budget season's here, so we are forecasting.
Definitely by year end, we expect modest rent growth and then rent growth throughout the next year. Still definitely not at the levels we saw in 2021 when we really reached 15% year over year rent growth, which
Yes.
just broke the charts, but modestly growing. We have great demand. So just as these buildings lease up, we're expecting rent growth.
Okay. Are there any other kind of data points or leading indicators that you personally watch for to check the health of the multifamily market?
Absolutely. So a couple that come to mind would be one, I think about overall vacancy, which right now is around 12, but thinking about stabilized vacancy, so those properties that have been around for 18 months or more that should have reached that at least 90% occupancy. We've gone from about 5% in 2021 vacancy for stabilized properties to nearly 10%. So just thinking about what people are having to deal with is really just competition from new buildings. And it's not just those new buildings that are needing to do some sort of incentives. You can see it in the data that it's happening across the board. And then another related piece I would look at is how fast are properties stabilizing. So if you look at properties built between 2015 and 2019, it was taking about 18 months to reach 90% occupancy. But in the past couple of years, with this wave of new supply, it is taking over 2 years. And so I know that's a huge change for people trying to deal with lease ups. And we're seeing that as we've added on new supply each year, buildings built in 2025 are going on an even slower trajectory. Even with great demand, it's still a struggle right now.
Okay. And have you seen any trends in like renter behavior and preferences
Yeah.
that we can expect for the year?
I think one thing I heard yesterday at the Apartment Association Outlook event is that we're seeing a greater number of retentions. They're seeing where they might have seen low 50% in the past couple of years. They're seeing more 58, 59% in retention. I think that's great to hear. What I was hearing over the past year is we have to focus on it. So I think that focus has really worked. Another thing that they were feeling is that maybe with some uncertainty in the world, that people are wanting to be a little more cautious, stay put a little more. I think that is a positive, obviously with good retention, but also with so many competitive concessions. What I was hearing a year ago is people were really hopping around trying to get 2 months free here, 3 months free here. But to hear that people are sitting and waiting a little bit right now, I think is very positive. And that the efforts that operators have been doing seems to be working. I have heard of some incentives for staying, basically just covering what moving costs would be. So not those 2 or 3 months free, but maybe one or fewer, some sort of concession there. And then I spoke with my colleagues at apartments.com just to see in the first half of the year if there was some growth in different areas for where renters are searching. One that I thought was interesting at the top of their list was actually around downtown, which has not had that many apartment units. There's been a ton of development there with Centennial Yards. Downtown is actually the most under construction market in terms of percentage growth right now. So
For the Atlanta Metro,
for
yeah.
the Atlanta Metro, to see people more interested in that area piqued my interest. And then of course we also saw more interest still growing interest around the Beltline and areas like that. Definitely excited about that retention piece.
I agree. What do you have any idea of why you think that Centennial area is seeing such, because that is surprising, right? Just knowing what we
Yeah.
know about the market, and for that area to be coming back, is the walkability, the access, like what do we think it
Yeah.
is? What are one of the driving factors?
Some components that I think are interesting would be it feels like city leadership right
Mhm.
now is really getting behind downtown. Metro Atlanta Chamber has had a big initiative, the city of Atlanta itself. And so there's been a lot more investment in the area. Just beyond Centennial Yards, there's been South Downtown, which is going to be adding housing. And they've put a lot of effort into safety of that area. The World Cup is coming next year to downtown. So
That
I
it's probably the
wonder
World Cup. That's probably what it is.
if people are saying like, hey, like it would be cool to be down there and in that area. So definitely an exciting time for downtown.
That's exciting for our city for sure.
Yes.
So, we're coming off a historic wave of new construction. What's happening with starts now that might affect the balance of supply and demand?
So we are down in terms of units under construction. We are 65% below the peak, which was just a couple years ago. So I think this pullback is actually a good thing for the market.
As an operator, it is, but
So it's a combination of things. It's not just that we have a lot of supply here in Atlanta right now. Interest rates have gone up significantly. You need a lot more. The banks are not willing to give as large a percentage of loans. So you're having to maybe pull money from multiple banks. There have not been a lot of multifamily sales. So banks have their monies tied up in other projects. And then construction costs have gone up a bit, not as much as people thought they would. So the budgets are doing fine, but that is still a concern. And these are national macroeconomic conditions. But yeah, we're seeing a huge pullback. It's interesting. We just built over the past couple years, basically at double time what we
yes.
had been building. So we've pulled back dramatically, but we are not that far off from pre-pandemic levels of construction. So it's still, people still want to build here. I think that's a positive sign. So it's really the balance of people do want to invest here. If they can pencil it, they will, because when they deliver in 2 years, they're going to be excited to be coming into a market that doesn't have that much competition for new buildings. There's some cool projects happening, Medley Johns Creek, obviously the Centennial Yards development downtown. I think when people can figure it out, they're excited to build here still.
Okay, that's great. What do you think is going to happen with setting up for potential supply shortage in 26 or behind, or beyond? How's that going to affect the renter? What does that look like?
I think because we have a significant drop off, but it's not, we're not down to zero offices
Yeah.
per se. I think we'll still have a healthy amount coming on, but I do think we'll see a shift where we've been seeing rent decline, we've been seeing a huge amount of concessions. I just think the power balance will shift a little bit more back to normal. We're at 12% vacancy now, so I think by the time deliveries taper off and we're really having not as much come onto the market, we'll be back around a more normal vacancy for Atlanta. It's
Mhm.
not, I don't think the market's going to be extremely tight. I think it will more be a normalization.
Yeah, I agree with the correction of everything,
Yeah,
really. And we've just been on a big wave,
absolutely.
peaks and valleys.
Yes.
So let's kind of shift our conversation to class performance here. So, why are 4 and 5 star properties showing strong absorption while 1 and 2 star properties are leading in rent growth?
Sure. So CoStar looks at properties in this 4 and 5 star rating system. So the 4 and 5 star would be like class A. And what's basically happened is that everything that's being built is in that 4 and 5 star group. So even though I would say 95% of demand or absorption is for those 4 and 5 star buildings. It's just that there is such a massive amount of supply in that category that they have not been able to keep up with rent growth. And on the other hand, in our 1 and 2 star properties, you can't really build 1 and 2 star, and it's those older properties, affordable properties where it's basically steady rent growth that's low. They weren't seeing the 15% year over year rent growth. So it's just little by little rent growth. And even in the 1 and 2 star, which is leading right now, it's still pretty flat. And so they are seeing the effect of the overall increase in supply, but they haven't had in their segment an oversupply.
The competitors just are not, the variance is large.
Exactly.
So are renters trending up for lifestyle or trending down for affordability? And how should operators of multifamily respond to that?
I think over the past couple of years, we have seen, just because we've had the rent decreases, especially in the 4 and 5 star, and the vast majority of concessions in 4 and 5 star. If you're a renter and you're doing the math, you can afford more likely now to be in a more luxury apartment. And so we've seen a lot of that demand go to the new buildings, and people have been chasing that. One thing that I've heard from operators is that because of this, whereas they might have used to been on a schedule of doing big renovations every 10 or 15 years, now to compete, they feel like they have to be more on a 5 year schedule.
That's true. Yeah.
Yeah.
5 to 7 years. Yeah.
Yeah. So I think that's been a takeaway for operators, is that people are expecting more of an upgraded experience as of this influx of new supply.
Yeah, I think you're definitely right about that. And it's just the timing has to be perfect for all of that.
Yeah.
Got to make good choices that are going to be classic to last,
Yes.
to have the longevity to
Yes.
compete. So, with the job growth in industrial, healthcare, and education sectors, it's obviously more stable than the office-based jobs. How does that tie into the multifamily demand?
Sure. So across the country, but also this trend is playing out in Atlanta, we've seen a bit of a lag in office jobs. I think that's for a couple reasons. One, with the interest rates being elevated, we're just not seeing the kind of booming expansions that companies were able to do a couple years ago. It's just a lot more expensive. And two, we're seeing a massive shift happening that we don't really quite understand yet with AI. So I think even companies that are doing well are not hiring like they used to, because they're saying, what can we do
Yeah.
here with AI? So again, I don't have a crystal ball, but I do think those office jobs are just not going to be seeing the growth that we've been seeing for the past 10, 20 years. I do think Atlanta, though, is such a diverse and strong market. We're not super tied to technology, but we do have good technology companies here. We're not super tied to one or another industry. So, very diverse group of companies here. So, I think that sets us up in a strong way for dealing with the new kind of conditions.
Great point.
But definitely something that's hard to predict for multifamily going ahead. But we're still seeing overall employment growth, and definitely strong growth in those population connected job sectors like healthcare, especially.
Yeah, it's always a outperforming
Yes.
demand for healthcare.
Yeah.
Are Sunbelt markets still outperforming others, or are you seeing shifts in that momentum at all?
Yeah, I think what's interesting is really the Atlanta story of that supply mismatch, basically just being that people want to be in the Southeast, people want to be in the Sun Belt. This story is happening in all of these other cities. So there was a massive amount of investment because the investments make sense here. And so when we're talking about rent declining and high vacancy, it's in the places where people are moving. So right around us in rent decline, we have Phoenix, Orlando, and Dallas, three of the fastest
Yeah.
growing areas in the country. But like you said, still outperforming in other ways. So we do have those kind of those metrics, but they're really just showing how much development happened here. But the absorption and demand that's happening in these areas is definitely outpacing other places in the country. It's interesting because you'll see pretty strong rent growth like in small, like middle of the country
Yeah,
cities
Midwestern areas. Yeah.
because they haven't had development.
Yeah.
It's definitely outpacing the country in terms of demand, but still lagging because we've had so much development.
So what I'm hearing is short-term pain for long-term gain.
Exactly.
Yeah.
Yes.
So I feel like we're definitely feeling that in the Sun Belt right now, but it's just temporary.
Yes.
So for our investors and our developers, so what kind of deals are getting done right now? Are suburban build to rent deals or workforce housing communities getting more attention? Where really is that shift?
Sure. Just a lot of my thoughts on this because I saw Shay Campbell from CBRE speak yesterday and he had some interesting tidbits. He mentioned right now the holding period average for deals is about 6 years, whereas the past couple of years it was like 3.5.
Yeah.
So we're really seeing money tied up, people holding on. A lot of the deals that are being put up for sale, a higher percent of them actually aren't ending up selling. What I'm hearing from a lot of people out in the market is that they're wanting those 2022 prices, but
Everybody wants 21, 22 pricing. I never thought I'd say it, but take me back.
exactly. So some more dominoes need to fall in terms of a bit of a price reset just for more to happen. People want to see those data points. But what he mentioned is selling is product built between the late 90s and early 20 teens. So like 1995 to 2014, where there is an opportunity. It's a building in a good location. Like we've seen a ton of interest in especially those northern suburbs that are growing and are hard to build in because of zoning or
Alpharetta is one of them.
exactly North Fulton for sure. So people do want to buy in these areas, those buildings where they can do
A
an
reno.
upgrade. Yes. But not necessarily like the 1970s upgrade that would be a huge amount of capital, but those kind of sweet spot of late 90s to 2015-ish.
That's also what we're seeing with our partners. Those are
Okay.
the assets that they're targeting as well. So it sounds like they're on trend.
Yes.
How are investors shifting their underwriting in today's climate of economic uncertainty and cautious rent forecasts? So have you seen a shift in that?
Yeah, and I think it's really just changing the mindset a bit with the merchant builders. I know they were trying to underwrite 1 or 2 months of free rent, but we're really seeing definitely more than that and just slower rent growth. But what I've heard from investors is that like this is the time, it's a bit of a low point. And so if you can understand the Southeast Sunbelt story long term, this is the time to buy. It's really when you can think about holding on to an asset for 5 or 10 years. They believe in the population growth here. They believe in the demand story here. So if you can get through a little bit of this very slow rent growth, they're thinking longer term that the Sun Belt is where they're going to see good returns.
Wonderful. Is there an area of opportunity, maybe a market, product type, or strategy that you think is currently underrated? I know you don't have a crystal ball, but just in your opinion, is there anything?
I think, I mean, you mentioned build to rent. So I think that's something that we're still figuring out, but has been just booming here in Atlanta, where the overall multifamily inventory has grown by about 1/3 since 2015. Built to rent has grown by 327%.
Yeah.
So I've seen a little bit of some smaller portfolios in especially the northern suburbs, but because the average age of first-time home buyer has gone up, I think it's about at 38 right now. Interest rates are high, but people really want that experience of owning a home. I think I'm interested to see where these trades go.
Yeah, I think we'll continue to see that trend. It's just if
Yeah.
you can balance it out with the density requirements.
Yeah.
So there's been conversation about fraud and eviction issues improving. What's changed and how are operators adapting, in your opinion?
Sure. So Fulton County was one of the worst places in the country about a year ago in terms of the time it took from when you wanted to get someone evicted to when they would actually be out of the apartment. So we, I think, had inflated occupancy for the past couple of years,
Yeah.
which it was pretty pretty low occupancy. So that was a struggle. The Apartments Association worked with Fulton County, and it was twofold. On the one side, we had that 10 to 12-month backup just in terms of the courts of getting through these cases. So it just took time to get through. But I know the other part was that you had to physically have a visit from a marshal. And so I think the Apartments Association worked to get them more resources, have more people be able to do that visit. And now I believe it's down to about a 2-month wait. So
Which is still
still
painful to
hard.
hear, but
So
it is a vast
yes.
improvement.
And they now a renter would be paying into an escrow account rather than basically just not paying anything at all for that long period of time. I think that has been, I've heard great things from operators about those changes because this was such a big problem. There was huge investment in technologies in terms of fraud detection. And I've just heard stories even beyond the technologies of you have a renter come in and it's like, you have to log into your bank account in front of me and I have to physically see that this is real because it was such an issue. And with all of our new buildings, it was attracting people to Atlanta to get these deals, and you could live here for a year without paying rent.
And they did, yes.
Yes. So I think the combination of the policy changes and the huge investments in technology there have changed that a lot. So I've heard there have been big improvements.
Good. Yeah. And there have.
Yeah.
But it's still it's an ever evolving cottage industry that we have to stay in front of as an industry. So let's go into insurance cost. Tort reform has been floated as a way to reduce insurance cost. Do you see that moving the needle for developers, in your opinion?
Yeah, I really hope so. Georgia was one of the worst states for nuclear verdicts. So those kind of massive settlements in terms of those big kind of billboards for lawyers and property owners, especially in Fulton County. You just hear stories of things that didn't even happen on your property were coming back in the lawsuits, these huge verdicts. So it was getting out of hand, and hearing from some of these owners, it was just untenable to get insurance for certain coverage like physical assault in Fulton County. And that's a huge problem. And that contributes to the affordability crisis because they're having to pay so much more for insurance or just have to cover their own liabilities if they can't get insured for certain things. They have to pass that cost on to the renter. So I hope that these changes will come through in having more affordable insurance because it's not just that they're having to deal with, it's more natural disasters. So even homeowners are having to deal with increasing insurance. So it's something that we need to keep an eye on for affordability.
Completely agree. So looking ahead, what do you expect the multifamily fundamentals to look like as we close out Q4 and move into 26?
Yeah, I think I have an optimistic outlook for the next couple of quarters. I think we'll keep seeing strong demand. I think we've had that pullback from developers, so we'll have fewer units coming on being competitive. I think we'll start seeing that rent growth. I think with that, owners will be able to pull back a little bit in terms of concessions as fewer things come onto the market. So I expect vacancy to keep going down, although it will stay a bit elevated. I do think it will continue to be difficult to do these lease ups with brand new buildings, but I think things are improving.
I think we all feel that sentiment and are very happy for a little relief and to hear that.
Yes.
What would your advice be to owners, operators, and asset managers trying to make data-informed decisions right now?
Yeah, I think listening to podcasts like this, staying up to date with your associations, just seeing what other people are experiencing and thinking about, I think the retention story is great. Thinking about one key data point that we can focus in on and make a big impact. And I think it's great that they've seen success in that, keeping the focus on retention going forward.
That's a good one. And this is final, so we're going to make it good here, okay? If you had to give the multifamily market a state of the union in one sentence, what would it be?
I think for Atlanta, things are looking up.
Okay,
Yes.
good. That's a wonderful way to end this segment. Thank you so much for your insights and just giving us some pure data points.
Yes.
Make sure you use CoStar going forward to help you make data informed decisions.
Thank
Appreciate
you.
you.
Thank you for having me.